Good evening, guys. Today we are going to start the fifth session of wealth management for working professionals. Till date, last time we have covered uh, about Warren Buffett, his way of handling investments, and his principles. And we initially started with how he exactly what the Warren Buffett is, and then we started with this, like what we were doing when we were uh, of age of 15. So we were, like as usual, like every other kids, we were playing, enjoying our life with our friends. Whereas Warren Buffett was a person who started owning several pinball machines in three barber shops in Washington DC, and also he owned certain listed shares, and also owned 40 acres of land rented by a farmer. This all through his own income and wealth. Nothing, he didn't take it anything from his parents, or neither it was inherited from his parents or grandparents. So this is about Warren Buffett. Warren Buffett, we had a little bit of idea about what he is, and then we discussed about efficient market hypothesis, which is a very important hypothesis that needs, you know, that needs a thorough understanding, because this basically determines whether you as an individual capable to outperform the market or not. And there were very few outliers like Warren Buffett. The other outliers happened to be Benjamin Graham, Peter Lynch, Druckenmiller, George Soros, and Julian Roberts. So we discussed a little bit about Warren Buffett, his own company Berkshire Hathaway, its net worth, its earning, its revenue, net income, total assets under management, and then we discussed about how do you exactly describe Warren Buffett. Then we went to what are the secret recipe of Warren Buffett per se as a person. Then who are the influencers? There are four people in the life of uh, Warren Buffett who influenced him the way he was, investing. And these all four influencers happen to be somebody whom he known, and also they are the victims of the Great Depression. And Warren Buffett himself and his family had happened to be the victims of that era. So these influencers basically totally changed the way investment is today. They are the people who are the pioneers in something called as investment. And it starts with Benjamin Graham, who happened to be his own mentor and his guru while he was learning his PG course in the University of Columbia, New York. So he is the person who has proposed something called as intrinsic value of a company, and then the margin of safety, which happened to be even today, it's a golden rule for all investors. So he also taught two rules. He said, rule number one is don't lose the money, and second, rule number two is you don't forget the rule number one. So this is the powerful influence which had on uh, Warren Buffett. And then the second one is Philip Fisher. Initially, he was highly influenced by Graham, whereas Benjamin Graham was very cold, and he was basically only interested in the total numbers, which doesn't say much. And it is Philip Fisher who brought a totally a new perspective. He was more bothered about the potential of a company to earn more. That is that needed something, he called it as scuttlebutting, whereby you need to do something called as the kind of market survey in which you have to engage with all the stakeholders of the company, so that these stakeholders will give you the deeper insights into what the company is and what are the things we should look into, what we should avoid. And initially he was of the opinion, whenever you have to look into any particular company, you have to look into two things. One is that You have to invest only into companies which have above average potential. They are better performing better than the average market. And then the second is aligning themselves with the most capable management. And he is of the opinion that the managers are the key drivers of a company. Otherwise, without managers, no company can exist, and no company can give sustainable profitability or the so-called sustainable competitive advantage over others. And then the third influencer is John Burr Williams. He was the person who has proposed the famous theory called as dividend discount model. That is the same model which is still in usage, even despite being more than 60 or 70-year-old. Even still, we are using the same model to calculate the value of a particular company, intrinsic value. So this gives you idea about it. And then the fourth happened to be his own buddy and his fellow, director of Berkshire Hathaway, and he happened to be associated with him for quite long till his death in very recently, I think in 2021 or 22 got expired. So these are the four people who influenced the life of Warren Buffett, from a person just like us who happened to have had more to do with something like technical analysis or the momentum trading or the short term trading. Initially, it was into the scuttlebutting, uh, it was into cigarette butt strategy. That cigarette butt strategy, usually, whenever we adopt that, we tend to take a cheaper companies which are valued much lower than its actual book value. So in the process, we assume that these companies, if we sell, if the market discovers the price, naturally we will be benefited because they are cheap. But that strategy failed badly, and later he had to go for the the so-called philosophy of your Benjamin Graham, whereby you pick up a stock which is much lesser than the intrinsic value is higher than the market price, and you have a margin of safety. So that became a guiding principle for him. But the differences has come up in between 1956 to 59, when he had a very close relationship, or rather association, with his mentor Benjamin Graham. Then he understood that you have to go beyond what is there in the numbers or the balance sheet or the so-called financial statements. You have to go to the next level. So he was of the firm opinion that companies will do well only when they are manned by the best of the best managers, and who understand the business and who are very professional, who can drive the company towards the so-called two fundamentals of financing. One is increase in wealth, either through incomes or through appreciation in the value. So then he from there he happened to have, initially was purchasing companies at quite lower prices, but all things have changed after the American Express issue, whereby he understood to purchase a good company, you need not have to go for a very cheaper valuation, but the price should be attractive enough to purchase a great company, because it had something called as a brand, it had something called as an infrastructure, and also it has certain sustainable ways, and they have developed some certain economic modes which will give a huge amount of profits. So this is the total idea behind the way Warren Buffett happened to have started his journey in investment, and we discussed a little bit about how the journey has started from his early childhood, and later on how it got matured and how it got changed. And then we have seen the changes in his strategies, which we just discussed right now. And then finally we had discussed about later day philosophy. And then I think I would reiterate, because this is the very important principle which we need to adopt. One of the principle is to buy great businesses when they are having a temporary problem. When the stock market declines and creates bargain prices for outstanding franchises. The meaning is that you identify some of the great companies either in Indian stock market or in American or in any other country. So identify those great businesses and always keep in the watch list. I identify whenever there is a small correction, maybe 10, 20 or 30 percentage. Keep on investing and keep on, getting reap the benefit the those great businesses will give in the long term. And then second very important suggestion for everybody is never predict the direction of the stock market or the economy or the interest rates or the election outcome of the election, and stop wasting money on individuals who do that for living, meaning thereby you be your own wealth manager. Don't depend on anybody's advice and never try to predict. And prediction often or most often they go awry. Even if they are consistently say 80 percentage they are correct, but 20 percentage when they go wrong they wipe out all your wealth. So don't make these predictions. Third, study the facts and the financial condition, and also find out how to evaluate the company's future outlook and purchase when everything is in favor. And this fundamental principle we will be, I have taken some 3 or 4 case studies where from, out of the way Warren Buffett used to do, and that we will discuss in greater detail. That will give you a greater idea about how you have to evaluate a company's value. And then next comes is Buffett says that what I do is beyond anybody's else competence. That means whatever he is doing, it's not that nobody can do it. Everybody can, do try to do that, provided you are more meticulous, more, you do your study properly, and you take your don't go into fall to the temptations, of especially being over sentimental, over optimistic, or too much attached to a particular company and its values or otherwise. And then what he said is you have to invest very wisely, and then be aware of all kind of temptations which will give you, don't try to have the so-called herd mentality which usually people tend to, like people tend to purchase a stock because everybody is purchasing, and they tend to sell because everybody is selling. It's not, that is not the way you have to make an investment. Investment is to be very carefully thought out, well planned, well, you need to have a meaningful understanding of what it is. You need to be very clear why you are investing, what is the purpose behind investment, and how long will you sustain, or whether, what is your horizon, what is the profitability you are looking at. So, and he always suggested that never be tempted to become foolish and never behave foolishly. So, now to start with, today there we are going to learn a certain fundamental principles which we will elaborate it much in deeper when we are making the case studies. There are some 3 case study. Fourth one I was, I didn't finish it. Maybe if people like love, we can complete somewhere around. There are 9 case studies. They give you very interesting insights into various different kind of businesses, and what was the approach Warren Buffett adopted, and what were the tenants, these tenants, how he had, used those fundamental principles to evaluate that business and to, invest into that business, and how we got benefited out of it. So let's start with these tenets. These are basically divided into 4 categories. To start with, there are the 4 kinds. Number one is business tenets. then the management, then comes his financial, and the last one is value tenets. Now the business tenet is the business simple and understandable? So according to this tenet, we need to know what kind of a business we are entering, that particular company is in. And is that business very simple? Can you understand it? Or is it so complicated that you don't at all understand and it is beyond your zone of competence? And once it is beyond your zone of competence, there is no point going for such kind of a business. And never invest into a business simply because somebody else have suggested you, or somebody, it became a fashion for the entire investment community. Never do that. You need to understand. You need to understand the entire business and the model, and whether it is simple or whether it is complicated. The more complicated, the better is you do, the better is to not to invest into it, because the complication may lead to gaps in your understanding. Once there is a gap in understanding, many a times you don't understand what is the likely outcome of your business decision. Then the second important tenet is, does the business have a consistent operating history? See, there are different kind of businesses. Certain businesses are cyclical, certain are defensive. Cyclical businesses are those kind of a businesses which has a sinusoidal or sine wave kind of a business cycle. Like for example, refrigerators. Refrigerators are used mostly during summers, and ACs are also a very good example. During winter we don't use AC, so the consumption during winter will be very less, whereas during summer it will be very high. And ACs in the hot countries would be consumed more compared to AC the cold countries. So you need to be wary of that kind of business operations. And also you need to know whether they are consistent in their operations. Is the management taking the business consistently? Are they pursuing wealth maximization or income maximization? Or are they inconsistent in their approach, sometimes shutting their company, or they are not at all in the process of having decent returns? Or could they penetrate into the market? Are the operations continuous? These are the kind of questions which you need to ask. And the third one is, does the business have a favorable long term prospects? This is a very important question, because many a times what happens is, whenever you are going for a short term approach, ultimately there is all likelihood that you may not get the returns which you are expecting. As per the SEBI study, it was found that 95% of short term traders, be it the so called futures and options, or short term trading, the so called momentum trading, they have lost their money, because the duration is too smaller, and market fluctuations are unpredictable. Whosoever try to predict it, they are doing, as I said in the previous principles. It is a foolishness. Nothing more than that. Hence, you have to take only those businesses which are very long term in prospect. So very maybe few businesses will fall into that category. One is like banking sector, your FMCG, then consumer durables, automobiles, insurance. All these sectors have the so-called long-term prospects. And then next is in the management tenets. First is the management rational? You need to see the managerial decisions and the rationale behind taking such a decision. Whether those decisions are taken based on the rationality, whether they are based on proper analysis, proper information, whether whether it is taken based on subjectivity, or based on fact, or based on proper study. And if the management tend to be, emotional, sentimental about taking decisions, then it is not rational. So you need to check into such kind of things. This will be reflected when you read the financial statements, and during annual when the uh, financial statement annual statement is presented. During that general body meeting, usually director will come up with the director's a speech that gives a greater insights and deeper insights into the prospects, whether what kind of a decisions, how are they judging about, either economy or the future prospects, or their future expansions, what kind of a decisions they are making. So all these things will can be judged in that particular through that statement, or else you have to frequently follow them and see what kind of rationale they are bringing up. Then the fifth principle is management candid with its shareholders. This is a very, very, very important tenet. Like, see, many a times when economy was doing well, everybody would like to share all the information. But when the things go bad, that is the time when the management may try to hide some things, because they don't want anything negative would impact their company negative. That is not the case. Managers should always be quite frank. They have to tell them why things are going bad, what is the reason, and if they have committed mistake, they should admit that yes, there is a genuine mistake. This is what the rationale I have adopted, and that went wrong. So there is nothing wrong with that. If you keep on hiding, that is what have happened when it comes to Enron. When the Enron or WorldCom, when they got burst, these were the biggest financial frauds that has happened in the entire what do you call in the history of corporate world. When the managers try to hijack, or rather you can say they were hiking the prices, so that that led to something called as, artificially inflating the price, whereby everybody has seen Enron as a great company, and the value of that stocks have started increasing. But later on, when it was discovered that there was a fraud which is going on, that was the time they have realized. By then, the company was totally into bust, and they have taken so many foolish decisions. The company was finally declared as a bankrupt. So you have to be very, very clear about such kind of a companies, and you should know where they are. Whether the shareholder is being given all the information. And another area where which I feel always we have to be wary of is the related party transactions. And unless those transactions are arm's length, or the so-called based on the fair market value principle, you have to be very, very careful about such kind of transactions. And then the next tenet is, does the management resist the institutional imperative? This is the next tenet. This in detail we will, you know, uh, uh, discuss at the later stage. Actually, see, when you, Vinod, can you just put it on mute? Yeah. Okay. So, see, in case of one company called as Geeko, they basically there was an there was a underlying principle that they will not go for any insurance for non-safe drivers. And in 1970s, when they wanted to expand their business, they left, right, and center. They started, giving insurances, or rather taking insurances from the so-called unsafe drivers, be it youth, the or the unsafe drivers which are known, without taking into consideration what should be the actual premium and what should be the costing. So they have deviated from the institutional imperative, and finally what happened is that Geeko went into huge amount of losses, and of course Warren Buffett have purchased it because he has sensed there is a huge potential in that business, and the right kind of a manager would plug in all those loopholes, which happened at the later stage because he himself was a one of the director in that particular company. And then these are the financial principles. There are four principles which you all have to look into. One, what is the return on equity you are getting? Say a return on equity is nothing but how much earnings, EBITDA. In the EBITDA, sorry, in EBIT, EBIT, earnings before uh, interest and taxation. This is the actual earning of a company. You have to divide it by the amount of equity. Equity comes from one is the issued equity, or when the share subscription is, share subscription plus the market premium or the share premium plus all the reserves divided by the number of outstanding shares, and per share you'll come to know what is the equity per share. Suppose say a company equity is including all things is say 100 rupees. So 100 rupees per share is the equity, whereas the returns EBIT per share, say it is 20, then 20 by 100 is 20 percentage. This is what is called as return on equity. And for a markets like India, you need to take into consideration what is the cost of equity. So cost of equity vary from company to company. Certain safe companies will have cost of equity less. Maybe it varies from say somewhere around 10 percentage to 15 percentage in Indian context. And it all depends on each country, depending on what is the interest free, the so-called, uh, what is that? Risk-free interest. No, risk-free interest is usually the interest rates of government bonds, which are of 10 years. So that gives you what is the interest-free rate. When it comes to India, it is 7.2 percentage. So anything above 7.2 percentage is said to be, little risky. But again, returns, you get returns only when you take a risky decision. The higher the risk, the greater the returns. So you need to have a very clear idea into those companies which are giving high return on equity, and never invest on companies which give you equity return on equity lesser than a benchmark. Say for in Indian stock market or Indian parlance, you cannot have a return on equity less than 15, 10 to 50, 12 to 15 percentage, depending on the kind of a company which it is. The more risky, the higher the return on equity. So, what are the company's owners' earnings? Right, owners' earnings are nothing but what is the retained earning after paying either see a bit after whatever the deduction of interest charges and then taxation. So whatever left out is the owner's earning. And with owner's earning, what the company is doing, there are two options with the company. One, either to give some amount or the entire amount as a dividend, or number two is to reinvest for further improvement of the business. So this is the next principle. Ninth principle is what is the profit margin. Profit margin is as a percentage over cost. You can take it as either as a percentage of a cost or either as a percentage of sales, but usually it should be linked to cost, because that's where whatever you have invested into, and whatever anything above that investment is your profit. Then 10th principle is to be has the company created at least $1 market value for every dollar retained. This is what is all about, what they are doing with the reinvested money. Say, suppose you are investing 100 rupees into, say, the company. What is the return you are getting? Are you getting one to one, or is it increasing? If it is increasing, that means company is doing well. If they are not giving exact return or lesser returns than what they have invested, that means the company is not at all performing as per as is desired or required. So you have to be wary about it. That means they are into loss making, and finally they may do they may not do well. So your whatever wealth will not be protected. So you have to be very careful about such kind of companies. Next tenet is 11th one, which is related to value. What is the value of the company? And we all get confused between value and the price. Value is what you get and price is what you pay. Value of a company is called as the intrinsic value. Intrinsic value is what is the capacity of the company to to generate certain cash flows in future, and whether those cash flows are, what is the percentage, so are they consistent, what is the final terminal value, and then finally you will decide what exactly would be the value of that particular company. The better the intrinsic, if the intrinsic value is higher than the purchase price, naturally you get a benefit, because you are purchasing at a lower price. So in case of any further appreciation due to price discovery, you will be benefited. And there should be something called as a margin of safety also. Like last time I explained, see, margin of safety is nothing but how much you are going to what is the price at which you are either going to purchase or not purchase beyond a particular point. To illustrate further, say a company has an intrinsic value of say 100 rupees, and you have decided that determined one third of it is what is the margin of safety. Like below one third of 100 is 33.33. So below 66.66, that is the price below which you are going to purchase. Above 66.66 or 67, whatever, you are not going to purchase, because that is above your margin of safety. So it has to be below the margin of safety. Usually in market parlance, they take it as 33%, because yeah, in case of corrections, usually it is around that amount which which corrects on an average. Like, may not be in some companies, it may be even much more than that. And it all depends on the quality of the company. The better the quality, naturally the fall will not be so high. So 12th principle, which is the last one, is, can it be purchased at a significant discount to its value? This is what I was talking about, margin of safety. So this is one principle you need to see. And in any case, at the end of you know his or at the fag end of his investment history, what he has done is he has departed from Graham's principle of margin of safety. He started paying 3 to 4 times, starting with one candy company, C's Candy Company. So he has shifted his total philosophy. He said that if a company is great and outstanding, you can pay multiples of the value of that particular company. So with this, we will start the case studies. Case studies are very interesting, which gives you a deeper insights into the principles, because whatever I explained, those 12 principles, they are very dry. How they are actually in reality would be known. And before we start, are there any questions? Vikas, Vinod, Toro, Ganesh. Very good question. So usually, great businesses have certain characteristics. Number one, they are into a business which are outstanding. Outstanding in the sense they can do in a very long term, right? They have a long term economics. Number two, they are leading in the market or the market leaders or maybe in top one, two, three positions. Second, third, they have excellent R&D. They can deliver or produce newer and better products and services. And then they have an excellent sales team which can market those products and generate excess demand. And fifth one is it should have an excellent management. Management should be very, they should know how to apply each kind of principles, keeping two things intact. One is the top line, increasing the revenues or growing sustainably. It need not be, exceptional growth, but yes, above average growth over a very long period of time. Then next is you have to see what is the profit margin they vis-a-vis their competitors. Is the profit margin decent? Is it above average compared to the entire of the thing? Is it consistent over a long period of time? Is it fluctuating? Are they booking losses? These are certain of the traits which you look into when you are going to identify the best companies. Is that okay? Because any other questions? Vinod, Oro, Ganesh. Okay. So let us start with the case studies. So the first case study is related to Washington Post. It is founded in 1877. Uh, it was, due to the original owners of the company, due to the financial crisis, especially in the Great Depression, they sold it to a financier called as Eugene Mayer in 1933. Even till date, it is owned by those people, and it happened to be one of the premier or the so-called one of the most famous uh, newspapers in United States of America. And after the death of Eugene in 1963, the metal was passed on to his son-in-law, who Philip Graham. He actually, this Philip Graham is a lawyer by profession, and he had further consolidated the company with his business acumen and a legal mind. And then after the death of Phil Graham, it went on to his widow Catherine, who took the mantle. But issue with the Catherine is that Catherine is not, in a she is unlike her father and her husband. She is not great at management, and she was totally new when she has taken over. And then she was confronting very, very difficult business issues at that time. And she understood that unless she has able hands to tide over the crisis, she cannot, take this company to the shores very safely. So she took two bold decisions. One is that she hired a brilliant manager by name Ben Bradley as a managing editor, and she called Warren Buffett as a director of the company. So these are the two decisions, bold decisions, that has totally transformed the company. Then later, what happened is that Bradley encouraged Catherine Graham to publish Pentagon Papers, especially on Watergate scandal, I think, which rattled the United States of America in 1972 to 74, and that led to, I think, resignation of Richard Nixon. as a president of America. That was the first time a president of America got, who he had resigned from his job. And this particular incident enhanced the reputation of Washington Post, and that won, prize-winning journalism. And then second is that Buffett taught Graham and her son, Don Graham, both of them, how to run their business quite successfully. And the best part is that they both, the mother and a son, both were willing to listen to the advices of Warren Buffett. That led to, a totally kind of an image makeover of Washington Post. And then before that, the company's value, got skyrocketed from $50 per share in 1950s to 1,154 in 1971. However, the profit sharing plan and the personal holdings of the employees, led to usage of company's cash unproductively. They were declaring huge amount of dividends, so that money was not reinvested, and leading to you can say improper usage of the cash generated by the business. In addition, Graham and Mayer family was facing a stiff inheritance tax, which is in recently in India also. It became, it rattled our Indian politics because of certain statement by the Congress politician Sam Petroda, which is blown out of proportion by the so-called opposition. And then the same issue they were facing at the time. In 1971, Catherine Graham decided that to take Washington Post public. So this decision would have, once they own a stock in the market, they would have escaped the so-called inheritance taxes. And the Washington Post was, what they did is, they have, once they went on public, they issue two different kind of shares. One is Class A and Class B. Class A, where the majority of this controlling stake will be there, whereas Class B will be having only minority stake. So what she very smartly did is, she took 50 percentage of stock in the Class A, whereby she had the controlling stake. So in 1971, they have issued the Class B stocks somewhere around 1.3 million. So despite, the threats from the government, Ben Graham, they have released the so-called documents related to Pentagon Papers. That, as I explained in the past, that led to, you know uh, the resignation of United States President. And in 1972, both the class of shares have increased steadily from 24.75 per share to 38 in December. And later, due to market crisis, market got crashed in 74, 73 to 74. One is due to Vietnam War, in any way that the US was waging a losing war, and they had a severe loss of reputation. Huge amount of money was spent on war. Then there was 1973 oil crisis, when the oil prices have suddenly got increased. Then weak US economy and political turmoil, especially as I explained in the form of Watergate scandal, and also crash of IBM stocks led to a crash of, even the shares of Washington Post got crashed. So ultimately it fell down from $38 to $23 by May 1974. In the same month, again there was another thing which has happened. Gold has broken $100 per pound, meaning thereby people have found gold as a better, safer investment option. And to rub salt on the wounds, Federal Reserve also have increased the discount rate to 6%. That subsequently led to Dow falling further 18 points. It's one of the biggest loss in 3 years. By June of 1974, the discount rate was again raised, and the Dow Jones have fallen to 900 level. So at that was the time Warren Buffett very smartly started purchasing shares, because he know that this is the moment he was waiting for, and this is the moment he was patiently waiting for since very long. And being part of the director, he had a lot of access to insider information, so he started accumulating huge amount of shares. So he took $10 million worth of 4,67,000 shares at an average rate of 22.75, and it made Catherine Graham very jittery. She was thinking that this was a acquisition by a non-family member and it may have negative consequences, and she was not at all comfortable. Later, Warren Buffett assured Mrs. Graham, that the entire it is only for investment purpose, nothing to do to take over the control or to put their interest into jeopardy. So what he did is to give further assurance. What he did is he said, "Oh, my vote share will be given to your son, that is Ron Graham, as a proxy. So he will, on my behalf, will keep on voting." That is how she developed the faith over Warren Buffett, and she allowed that to continue. And that made him to join as a board of directors in 74, and later he was made as a chairman of finance committee. So this is then the Buffett's role, whatever he played in Washington Post is known to the investor community, and that helped Catherine Graham to tide over a lot of so-called strikes. There were many strikes in the past. The company, what they used to do is they never used to negotiate. Whatever they used to ask, they used to pay. But this Warren Buffett taught them that yes, you have to keep the costs under control. If you keep on paying heavy wages, that may lead to unsustainability of the company, and in the long run, it will be negative to the company. So he told them not to uh, have a give this mm, unions to take a ride over their company. So that is how finally, he encouraged this management to take a decision not to hire people from the unions. So that has transformed the entire company and led to a reduction in the so-called cost. Now, let us see the tenets one by one. Simple, whether this is a simple and understandable business. Yes, Warren Buffett happened to, his grandfather owned a company, and they have even edited a weekly called as Coming Country Democrat. And and his grandmother used to help his grandfather in typing and setting up all these stuff. So his father was also, while attending the University of Nebraska, he edited a daily called as Nebraska. And Buffett himself was circulation manager for one journal called as Lincoln Journal. And it is said, see what it was believed widely that Buffett, had he not been into the career of investing, he would have been into journalism. So, since it is a known area for him, he had developed a comfort, and that led for him to understand what exactly the business is. And further, in 1969, uh, Buffett himself purchased a major newspaper company called as Omaha Sun, along with a group of weekly newspapers. And this gave him the insights into the entire of the business, what the business is, what is the model in which it runs, and how do they conduct the business, what kind of returns they can expect, and then so on and so forth. That gave him a rich experience of 4 years, and this experience helped him understand the entire business model. So he felt the company Washington Post is an ideal candidate for further investment. So let's see the next tenet related to consistent operating history. Is the company having consistent operating history record or not, or it has a checkered history? So let us delve into a little more details. See, Buffett himself, when he was a kid of 13 years, he was a delivery boy of two newspapers, Washington Post and Times Herald. And this experience, he understood who are the customers, what are they, how popular is that particular the newspaper, and so on and so forth. And then these, fortunately or unfortunately, both the companies are purchased by Washington Post at the later stage. So the merged entity is now with Phil Graham, who purchased both. So Washington Post company had been reporting a stellar performance of its broadcast division, and then Buffett quickly learned the value of the television companies, because that was a time, that was an era, people have slowly migrated from the print media to the visual media. Visual TV has come, TV became popular, and it was growing in business, roaring. And Washington Post also has a television business, so he understood the insights of that. And then Buffett's experience, as I said in the past, he was called by Catherine Graham into as a board of director. That gave him much greater insights into the company, how it is operating, and all that stuff. So now, next tenet is related to favorable long-term prospects, and it's very quite interesting. Uh, Newspapers in those days happen to be having a huge or very dominant economics, and regarded as one of the best, and they are shielded from inflation. Most of the times, even the mediocre papers, if they are monopoly in a particular place, they themselves had huge amount of profitabilities, and the owners are making good amount of decent profits despite journalistic quality, irrespective. Sometimes, as I said, if it is a monopoly, naturally nobody is bothered about the quality, because being a monopoly, virtually they get a huge amount of profits. Mm. So next is high quality papers will always have higher penetration, and mediocre also will make money, because in any case it is required for bulletin board, and advertisements are the one of the primary source of income. So people want to put ads in whatever the newspapers whichever are in circulation in that area, they tend to put their ads. So even every town, a business town, every home seller, every individual used to get message from circulation, and you often don't find people who is not at all subscribing to one newspaper or the other. So it is a kind of a ubiquitous or daily necessity kind of a thing, and since they are priced very cheap, naturally everybody can afford to purchase it. And like Canadian media entrepreneur Lord Thompson said, Buffett also believed that owning a newspaper was like receiving a royalty on every business in the town that wanted to advertise. See, advertisement is a kind of a regular income. So it's like a royalty. Royalty is also, an income for the owners. So it's that is the power of the newspapers. So what he did next is, apart from this, franchise quality, they have one more quality which is called as economic goodwill. Then newspapers have a very low capital needs. And since, see, what is required, you need to initially invest into the printing equipment or any other accessories. Nowadays it is computers and all that stuff. Once you have, when it comes to television channels, it will be like, broadcasting equipment, satellite, all that stuff. Once that investment is made, rest all is core profit. They need not, that keeps on churning. The consumables when it comes to newspaper is newsprint. Other than that, nothing much. And then the other payments you will be making is to the reporters. So these are the expenditure. The rest all is quite simple, and the business is solid. And in 1970s and 80s, that was the time when, uh, they have started getting competition. One from television channels, two from cable TVs, three, that was the formative years of internet. And then internet, once it has come, that it has totally collapsed this, newspaper business. Now of course newspapers have also now totally changed their business models and made it into internet, or the so-called e-papers. So even now they are still a very solid businesses, and they have above average returns on the invested capital, and also they have a potential to increase the prices, having a monopoly, and they can shield themselves from the effects of inflation. So this is in nutshell about whether it has a favorable long-term prospects or not. Then let's go to the next one, that is related to how do you determine the value. Value is a very interesting concept, and you need to be good at valuation. What he says is, in 1973, the total market value of Washington Post is $80 million, and yet Warren Buffett, what he was claiming is, he was claiming the intrinsic value to be $400 to $500. So everybody were aghast. They were very, perplexed. How this gentleman could evaluate it as 400 to 500 millions? How did he arrive at that particular estimate? Is he estimating correctly, or is his estimate something, it's over optimistic? So now let us see, let us calculate whether what he said is right or wrong. So usually it is the income, the net income is somewhere around 13.3 million when he took decision in 1973. Plus, if you take out depreciation and amortization, minus you take away the so-called capital expenditure, it will yield around 10.4 millions. And what we need to do is we have to divide by a factor. That factor is usually long-term US government bond yield, which is 6.84. If you divide 10.4 million with 6.84 percentage, that is 10.4 divided by 0.0681. Then the value of Washington Post is around 150 million, which is twice that of the market value. But definitely it is well short of Warren Buffett's estimate. Buffett, what he says is, what is his explanation is that over time, capital expenditures of newspaper will be equal to depreciation and amortization charges, because whatever initial expenditure is, that's it, that is fixed. Beyond it, nothing much will be there. So therefore the net income should approximate owner's income. So whatever the income will be, it will be the owner's income. So if you know about this, that is, we can, if you divide it by risk-free rate, the valuation is coming to around 196.8 millions. So if you stop here, the assumption is that the increase in owner's earning will be equal to the rise of inflation, right? There is something called as an inflation in between also. So we have to take into consideration that influence as well. But one more factor which he has taken into consideration, which others haven't, is newspapers have a unusual pricing power. They can beat the inflation because they are monopolies in their community. They have a flexibility to raise the prices, and the elasticity of demand is almost negligible for any amount of increase in the prices. And then what made it, even if you put that last assumption, and say it has the ability to raise by 3% of the value, even then the value comes only to $350 million. So Buffett also knew one more thing. Companies 10% pre-tax margins were below 15%, 15-year 15% is their average historical average margin. So currently it is trading at 10%. So he thinks that with the approach of Catherine and the management, definitely the margin will increase from 10% pre-tax to 15% definitely. And by adding that particular 15% to it, the company's uh, value is increasing by 135 millions, and totally bringing the final intrinsic value as 485 million, which is 5 times of the market value. Sorry, 6 times. So this is how he came out. It requires somebody to be a genius to understand this and arrive at this particular conclusion. So he has taken this company at 20% of its actual value. So it is a one of the best bargain anybody can ever think of. So the next one is, did he buy at an attractive price? Yes, of course. See, he is purchasing less than quarter of the value, that is less than 25% of the value. So naturally, it is it has satisfied the Benjamin Graham's premise that you have to purchase any business at a discount to the intrinsic value. And also it has created a margin of safety. Margin of safety in this case is more than 75%, which is too huge, too big. So now let us see what is the next tenet. It is about return on equity. What is the returns with that particular company called as Washington Post generate? So when Buffett purchased Washington Post, its actual equity is just 15.7 percentage, which is almost an average for most of the newspapers, a little better than S&P 500 industrial index of Dow Jones. So, but in next 5 years, it got doubled. Return over equity has increased to almost 30%, and then which is much higher than S&P industrials, and also 50% higher than mm, the so-called the average newspapers. And over next 10 years, the Post, that is Washington Post, maintained its supremacy, finally reaching 36% return over equity in 1988. It's a huge increase from 15% to 36%. And then the above average returns are quite impressive. If you see, When the returns keep on increasing, naturally what they do with surplus money, they tend to reduce the debt because they are getting huge amount of returns. So what they do is they clean their balance sheets by reducing debt. So that has happened in 1973. The long term debt stood at 37 percentage, which was the second highest in the entire newspaper group. By 1978, Catherine Graham could reduce the debt by 70 percentage, and by 1983 long-term debt to equity is just 2.7 percentage, which is 1/10 of the newspaper, the entire average of the newspaper. So this is the churn. That is why you need to look for companies which are giving good amount of return on equity, and it is a sure shot or a recipe or a guarantee that these companies will be quite successful, and they will be most often debt free. If at all debt will be there, that will be very minimum, bare minimal you can say. So later in 1986, after they have invested into a cellular telephone systems and purchasing capital cities, and then which we have a case study at the later stage. Capital cities 53 cable systems. Debt of the company was so high, the purchased company is 336 million. Within a year, they have reduced 155 million because the surplus which is generated by Washington Post was used to reduce the debt. And by 1992, long-term debt was just 51 million, and the company's long-term debt to equity was just 5.5 percentage, which is well above the industry average of 42.7 percentage. Right? Any issues regarding it, or should we continue? Okay. The next tenet is related to profit margins. Profits are nothing but the surplus is generated after taking care of all the costs to the company. The cost can be one, the cost of purchases. Second, it can be the cost of the labor or employees. Third, administrative expenses. Fourth, marketing and distribution expenses. Fifth, it can be the interest towards the equity debt which they have raised. And then sixth will be your depreciation amortization. Then the seventh, it will be taxes, and if any, after deducting all these expenses, whatever will be left out is called as profit. And profit margin is nothing but what is the amount of profit you are making, surplus you are making over the costs. So if the percentage is on a higher side, naturally the company is performing better. If the profit margins are low or it is into losses, then the company is not performing well. So after they have, the profits of this company started rising at television stations and Newsweek, which is one of the newspaper, one of the many newspapers which they had. But the profitability at the newspaper level, entire level, is it is almost the same. And what is the reason for it? One is the high production costs, only because of the wages, as I explained in the past. The profits of the Times, this Washington Post, it has increased after it has taken over Times Herald, because the costs of that particular company is relatively lesser compared to Washington Post. Why there was high costs, especially of wages, is because whenever there was a union strike, the paper management opted to pay their demands. However, you know, uh, you can say whatever kind of a demand they have raised, they used to pay. They used to hike the pay, irrespective whether it is uh, as per the industry norms or not. So they were paying heavily. So they always thought that it is always better to pay more than risking a shutdown of the paper, because once you shut down the paper, you are totally wiped out of the business, and again regaining business will be very 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 difficult. It's a big challenge. So union's contract got expired in 1970s. And what Graham did is, this is one of the reason when she went into the market, she said she's willing to increase the profitability of this company. So what she said is she will be reducing the cost. One of the area where she has to reduce cost is reducing the wages. To reduce the wage, she need to bargain very tough with the labor unions. And 1974, they could defeat the strike after a very lengthy and protracted, negotiations. But however, because of the tough stand taken by the management, the unions became very, very volatile. They became violent and bitter. They started vandalizing the company. They vandalized the company, and once this, before the strike, this is the moment when they lost the so-called sympathy, and then later, with a very tough bargain, uh, Mrs. Graham started hiring people from non-union press. So later, that this has led to a lot of reduction in expenditure, wages, especially the wages were fell down. So it led to, pre-tax margins in 1973 was 10.8 percentage, which was below the historical margins earned in 1960s. And later by 1988, it has increased to 31.8 percentage, which was a tremendous increase, almost three times an increase. So where it went in favor of this particular newspaper group, when the average of the entire the industry is around 16.9 percentage, while S&P Industries average is 8.6 percentage. So this is the rationality. This is the rationale which Warren Buffett took to purchase a company at a quite cheaper price. Now let us see rationality of the managers. Washington Post generated substantial cash flows for the owners. Because it generated a lot of cash flows, they could reinvest into the business, primary business. They have two options, as usual. One, either to return it to the shareholder, or to reinvest that cash in either into the same company or into the new opportunities, either expanding their existing geography, or into other products and services. So these are the two options which they had. But Washington company, what they did is they have taken a very very smart decision. See, they have huge amount of surplus cash which got generated. So what will be their do? If they give it as a dividend, naturally, there will be dilution in the company's cash balances. It will reduce the so-called the market price of the company. So what she did is she started buyback, started purchasing the buybacks. So they allocated substantial chunk of money, and then they purchased the whatever amount which is left out with the so-called minority stakeholders by more than 43 percentage of its the average price, and at a average price of 60 per dollar. So this has increased the share price from what we have seen, $23 to $60 by 1991. So next is what they did is that it has also started paying dividends, and by 1990 they were confronting with a substantial cash reserves, and then what to do with the surplus cash. They have issued, in fact, company has voted in favor of giving annual dividend to the shareholders from 1.84 in the previous year to $4 per share, which is a 117 percentage increase over the past. And by 1990, early 1990, Buffett concluded that the newspapers would remain above average businesses when compared to the American industry in general. And later, newspapers have lost their price flexibility to the factors which I explained in the past, especially after the so-called satellite TVs, then your internet, all these coming as a substitute to the newspapers. So in the previous years, when the economy slowed, advertisers used to cut the spending. Newspapers could always maintain profitability by raising the rates, price. They suddenly increase the price because the price of newspaper is so cheap. Every penny increase would mean that their so-called profitability has increased leaps and bounds. So today it's not the case. Now they are no more monopolies, and advertisers always found some cheaper ways to reach, either through city cable or so called cable television, or through direct mail or newspaper inserts and other ingenious ways whereby they started reducing their advertisement bill from the newspapers. That is the threat these newspapers have got into. And uh, okay, so this is in effect about rationality. Then there is one more tenet, $1 premise. The premise of $1 is that every $1 which is investing, what is the churn, what is the return the company is making. If the company makes more than it invested, it is doing well. If it is not making more than what it invested, naturally it means that it is shrinking. It is into a shrinking business, or business is taken a heavy so-called headwinds, and it is a sure shot recipe for a disaster. And later the company may land up into severe losses, finally a bankrupt company. So you need to understand, whenever you take any decision into consideration, you just have to check what is the investment they are making, whether that is matching with the increase in so-called profitability, right? It can be an increase in the revenues. Say 100 crore is invested. That 100 crore, is it leading to more than 100 crore revenues? If it is leading to more than 100 crore revenue, that means the company is doing well. If it is getting less than 100 crore revenue, it's not making the returns what it should ideally have. So this particular thing, it all depends on the capability of the managers and how they could deploy the whatever the retained capital is there, how they are using it. If they deploy it properly and put them into, one, either into R&D, whereby they generate better products, or into increasing the capacity of the company by investing into the so-called machinery plants, M&P, and expansion of the company, or putting them into, or starting new operations in new locations, or they are hiring more and more a smart sales team who can sell the products. And all these are the things which they have to deploy it properly, and they have to plan it. That is where the capability of managers or the management come into picture. So when it comes to Washington Post, from 1973 to 1992, they have earned 1.755 billion as retained earnings for their owners. So that is the reserves and surpluses which they have generated, and from that they have paid 299 million to the shareholders in the form of dividend, whereas 1.546 billion is reinvested into the company. And in 1973, the total market value of Washington company is just $80 million. By 1992, the market value had grown to 2.63 billion. Next, during this 20 years, for every 1 rupee invested retained by the company, it has created 1.81 in the market value for the shareholders. It's a huge value which the company has generated. Still, one more way to judge the success of Washington company under Catherine is from the time IPO is issued in 1971 till she stepped down as a chairman in 1993. The compounded annual return for the shareholders was remarkable 22.3 percentage, huge, humongous by any standards, even in our country like India, which is emerging market. Even in the emerging markets, it is very rarely you find this much of wealth generated by any company. Maybe there may be few, but yes, huge by any standards, it's huge. In fact, S&P could only produce 7.5 percentage compounded annual returns, whereas her peers means other newspaper agencies, on an average they have produced just 12.4 percentage compounded annual growth. So a dollar invested in IPO was worth 89 by the time she retired. Means in just 22 years, it has grown 89 times. 89x is what is the profit derived out of that particular company. And that was, when it is compared with S&P, it is just $5. And when it comes to other peer group, it is just $14. So just imagine, it was outperforming its peers by 6 times. And I think it is one of the smartest decision Warren Buffett has ever took. So this is in nutshell about that. We have discussed how each of the principle is being applied. Are there any questions, or should we move to the next? Okay. Okay. Thank you. So, Geico is basically a government employee insurance company which is founded in 1936 by Leo Goodwin, an insurance accountant. He was an accountant in an insurance company. He identified a very, particular trend that became a founding principle of his company. What he understood is the government employees are the most risk averse drivers. So they had fewer accidents compared to the general public. And second observation is that very important, pertinent, being into that industry. He understood that the entire of the insurance business is run on through agents, and agent typically used to take anything between 10 to 25 percentage of the premium. So these are the two basic premises. He what he did is he had, you can say, fused both the things, both the two observations. As a fusion, he made a very successful and a wonderful business model in which he will only sell it to government employees, nothing to any other general public. Second is, this entire thing is not at all through any agents, rather it will be direct, through newsletters or subscriptions directly from the public. So these two things, since one is they are going into a clients who are less risky, so he will be getting a huge premium compared to, or the premiums are better than others, and that he could transfer it to the end customer. So he used to sell it for cheap compared to his all the competitors. So that cost benefit he got. At the same time, since they are not risky, the commitments, the so-called underwriting will be much lesser. So once your underwriting charges are lesser, naturally your profitability or the profit margin is bound to increase. So Goldwyn, what he did is, Goodwin invited a Fort Worth, a banker, whose name is Cleves Ria, and he explained this particular model to her, and she invested 75 percentage of it, whereas he has invested only 25 percentage of it. And then they have moved their company from Texas to Washington DC. That was a time when a Ria family, the major stakeholder, sold the company to Benjamin Graham. Benjamin Graham happened to be the mentor of Warren Buffett, who decided to buy the half of Ria's stock for 720, thousand US dollars. And the other is Kreger and Davidson's Baltimore Associates. So these are the two people who has purchased the other stake, like 37.5 percentage and 35.7 percentage by these two guys. So there was at that time SEC, like SEBI in USA, US stock market, there is something called a Securities Exchange Commission. They have forced Graham and Newman, the partnership firm of Benjamin Graham, mm, to limit the holdings of GEICO to only 10 percentage of the company instead of 37.5 percentage. What he had to do is he had to distribute to the funds partners, whatever the partners, since theirs is a partnership firms. So they had taken a decision to avoid, SEC restrictions. They have sold it to their partners. So the next thing what happened is Lormier Davidson, at the invitation of Goodwin, he joined GEICO as GEICO's management team, and by 1959 he became a chairman. He led the company until 1970. This was the period board extended the eligibility of GEICO's car insurance. What they did is, apart from government employees, they have extended it to professionals, managers, technical and in the administrative workers. And GEICO's market insurance now has included 50 percentage of all cars. From in the past it was only 15 percentage. So they have increased the market penetration definitely, but the new strategy was definitely a success, but there was a pitfall to it. Underwriting profits soared because new group of drivers turned out to be just as careful as, the employees, government employees. So it was a huge thumping success. One, they have increased their their market reach. At the same time, their top line as well as bottom line has increased, and that made them to the so-called, the regulators, insurance regulators, to allow them to have a higher 5:1 premium, whereas for the other companies, the premium to surplus ratio, I'll just explain you. Like, see, the incomes generated by an insurance company is in the form of premiums. Premium is what we pay to the insurance agents. Whereas there may be a claims. Claims will be whenever there is some accident or the contingency. If you are a car insurance, you go to claim only when there is some accident or some death due to negligent driving or during the accident. That is the time when the claims come. So what they used to see, industry norm is like to have for every 5 rupee as a premium, one is allowed to this, whereas for the other companies, because they are managing badly or they are taking insurance from the so-called risky category drivers, the premium to surplus ratio is less than 5:1. It may be 3:1, 2:1. So this led to this company to have that extra 4, the ratio of 4 or 80 percentage extra margin that they used to use it. That is the surplus which is generated. So because the insurance regulators were impressed with the GECO, the company was allowed to exceed the industry average ratio. So by 1960s, the fortunes became dim. In 1969, what they did is company reported underestimated its reserves by 10 percentage. Instead of earning 2.5 million, they have actually posted losses. The adjustment of income was made the next year, but again the company underestimated reserves. Again they have underestimated their reserves by 25 million. So again they have shown losses. So this was a time the revenues in the insurance company received from policy are called as earned premiums, and from the premiums the company promises to provide coverage for the automobile drivers during the year. Cost, what are the cost element? Cost which will be, I think this I have already explained, but again I'll reiterate it so that it will be very clear with you. So cost to the companies, what are those costs? One is the insurance loss when they suffer due to the claims by drivers and loss expenses, then administrative costs for settling those claims, and then the total cost must reflect not only the payments made during the year but also about the estimates of claims yet to be paid. Okay, and yet to be paid category will be into two categories. One is claim costs and expenses which company expect to pay during the year, like in the next upcoming 1 year. What should be the cost, how much they have to allocate. you know if they allocate less, naturally it will cost more for them. If they allocate more, there will be like they could have used that particular capital for some other purpose, so that there will be an opportunity cost to it. Then there is something called as an adjustment reserves. They are set aside to cover underestimated reserves for the earlier years. If in case if you have underestimated the reserves in the earlier years, like the claims, say you thought that next year the claim will be only 25, or 25 crores, but whereas the actual claim is 30, so they have underestimated by 5 crore rupees. So this is one thing. Then because and since it is an insurance business, there will be a lot of litigations. People will make claims and then they will go for legal battles, and finally you tend to pay more. Many a times it was all about whether how far the claim is accepted by the company, and then there will always be a dispute. Each customer may view it totally differently, so whenever there is a dispute they used to challenge it legally. So that is the problem with insurance companies. So the problem which Geeko confronted was that it written insurance policies that was poised to create an underwriting loss, but its estimates for the earlier reserves were inadequate as well. One is that now they have taken the riskier insurances. Second is they are underestimating their reserves, which is inadequate for future claims. So they, between 1970 to 1974, the new auto policies grew by 11 percentage annual compared to 7 percentage on an average between 1960 to 70. What they did is in 1972 they became very ambitious, and then they started a program called as decentralization program, which is quite expensive. And then what they did with the surpluses which they had, they invested into real estate, computer equipment, and personnel. In 1973, they faced fierce competition. How they got that competition? Lowered by its eligibility standards to expand its market share. They wanted to expand the market share at any cost. So what they did is they have lowered the standards. Instead of taking only the safe drivers, they started enrolling or issuing insurances to blue collar workers, drivers under 21, and all those groups. All these two groups, they have a checkered histories. They are prone to claim much more than what they are paying. So this will hurt the company very badly. So both these strategic changes led to a lot of claims, and then due to the claims, the expenses got soared. Finally, it booked huge amount of losses, especially in the year 1974, and the company started reporting $6 million losses as underwriting losses. It was for the first time in 20 years they have reported such a huge underwriting loss. Still, despite that, premium to surplus ratio is same. They did not make any changes. It was still 5:1. That means they are not keeping enough for the future claims. Despite that, in the second quarter, they have reported more losses. Finally, they have decided not to pay the usual dividend, which they pay at the rate of $0.8 per share. So, what did the management do is they have hired a consulting firm by name Millman and Robertson to make a recommendations how to reverse its slide or how to arrest the further losses. So company and consultant said one is that under reserved by 35 to 70 billion. That is what is the reserves they should have put for future claims. And also they need capital infusion. Without capital infusion, they cannot sustain any further, because unless the capital is infused and unless they make corrective actions, they cannot sustain in the long run. So what they did is board has agreed to the suggestions which are given by the consulting firm Millman and Robertson. Apart from that, what they have projected is in 1975 underwriting loss would approach a staggering 140 million, and shareholders and insurance regulators were dumbfounded. They were so surprised when such a huge projection was made for huge amount of losses due to underwriting. In 1972, Geico's share price was it has reached the high of 61 per share, $61 per share. By 1973, it fell down to half, and by 74 it further fell down to $10, and in 1975 it dropped to $7. This was the moment of reckoning. This was the time which Warren Buffett was waiting for. And several stockholders charging, they charged fraud. There were so many first class action suits against the company. Executives blamed the inflation. That blame game kind of a thing started coming up. You know, there were so much of legal and medical costs for the companies, and these are all the troubles which are confronting the company. And then, as the company expanded, the list of insured drivers also kept on increasing. So again, they were, underestimated the insured losses, which was also need some fixation. So in 1976, GEICO had an annual meeting. Eden confessed that another president might have handled the company's problem better, because he was the person who went aggressive. He only had started accepting all the risky kind of a drivers into it. So the board has decided to seek a new management. That was a time GEICO's share fell even further to $5 and even less. After 1976, GEICO announced that John Bayer, a 43-year-old marketing executive from Travelers Corporation, has become a new president. Soon after Bayer was appointed as a president, company announced 76 million preferred stock offering to shore up its capital. So it was one of the recommendations of the consultant. So now he has announced that $76 million of preferred stock will be offered, and then, but shareholders didn't had any hope, and so the stock has further drifted down to $2 per share. It became a penny stock. This was a period when Warren Buffett, who was waiting very quietly, pounced into action, and he immediately bought the GEICO stock, and then he invested 4.1 million by purchasing stocks at the rate of 3.18 per share. So what Warren Buffett did is, so this is all about the decision related to $1. Sorry, this company. Now let us start with the tenets, so that you can understand how the principles are being applied. When Warren Buffett attended one of the Columbia University, his teacher Ben Graham, he was the director of GEICO. So uh, he that increased the curiosity in Warren Buffett to visit the company and know more about that particular insurance business. So on one Saturday, he knocked the door of company, and to find that only one person was there, janitor. After banging the door for very long, nobody has responded except the janitor coming out and then telling that there was only one person in the office. He was a vice president, Lorimer Davidson. So he met that gentleman, and there was a huge amount of conversation between them. And that is the first time Warren Buffett understood about the business of insurance. So that made that this experience gave him an insights into the business. Then later, when he returned back to Omaha, his native place, his father's brokerage firm, and his father, he worked for his father's brokerage firm. So he started recommending to all the clients to buy GEICO, and he initially invested somewhere around $10,000. At that time, it was two-thirds of his net worth of all his stocks he is holding. So many investors were not at all happy with his recommendation. Some resisted openly, some didn't, otherwise they didn't heed to his recommendation. So Omaha's insurance agents also have complained to the Buffett, his father, Howard Buffett, that his son is promoting an agentless insurance company. So frustrated, what Warren Buffett did is he sold all his shares, of course, at 50% profit. And then till 1976, he did not purchase any further stock. Buffett, despite that, he started recommending the same stock to his clients, and he bought prior to purchase of Geco, he purchased an insurance company by name Kansas City Life at the price of three times its earnings, three times of its P/E ratio. Then he owned another company by name Massachusetts Indemnity and Life Insurance Company in the Berkshire Hathaway's security portfolio. And in 1967, he purchased a controlling interest in the National Indemnity. That means he understands the entire business, he had the entire experience of handling the business. So this is how it led him to take a decision to purchase Geco Corporation. So next is, for next 10 years, there was one CEO by name Jack Ringwald. In the previous session also I explained him when he purchased the remaining stake of Berkshire Hathaway. This was the gentleman who suggested to purchase at at the time $50 per share. So this gentleman, he was the CEO of National Indemnity. He was the one who educated Buffett on the mechanics of running an insurance company. That experience has helped him to understand how insurance company makes money, and in future to come, this decision of purchasing insurance companies made Berkshire Hathaway, otherwise a bankrupt company, into a very successful company. And then in addition to Berkshire investing 4.1 million 1 million into Geco's common stock, Buffett also purchased 19.4 million stocks, convertible preferred stocks, when the company was raising, as I said in the past, I think how much, 76 million. That means almost 20 percentage of convertible preferred stocks he has purchased. 20 percentage of the so-called issue of preferred stock is purchased by Warren Buffett himself. And 2 years later, from preferred stock, he has converted it into common stock. The only difference between preferred stock and common stock is preferred stock will get premium over the dividend which is given to the shareholders, and that dividend payment is irrespective whether company is performing well or not, whether other common stockholders are getting dividend or not. And also, whenever the company go bankrupt, the first claim will be for the preferred stock, then comes the common stock. So this is what is the difference between these two. So in 1980, Buffett invested another $19 million into the same company, and between 76 and 80, he invested around $47 million, purchasing 7.2 million shares of Geco at an average price of $6.67 per share. By 1980, that investment appreciated 123 percentage, and it is now worth 104 million, and had become one of the largest holdings in the Buffett's portfolio. So now let's see whether the next principle, consistent operating history. We need to then on the first reaction we might assume that Buffett violated his consistency tenet. Clearly, Geeko's operations in 1976 to 1979 were anything but inconsistent. See, they have deviated from their norm. What is that norm? Norm is to sell insurances only to one, people who are safe drivers. Number two, only by direct sale to the clients. Whereas they have deviated from that principle, especially the principle number one. They have entered into a risky kind of insurances, especially of the so-called blue collar employees and the young people below 21 years. So this is not inconsistency with the actual principle of the business founders. So that has backfired. Uh, when the when Bayern has become president of Geeko, the guy who has transformed this particular company, the job was to turn around the company, and turnarounds, Buffett often said, seldom turn. Actually, they go bust. They will be usually a disaster. So, Pine successfully turned the company and positioned it to compete again for insurance. Its franchise for providing low cost agentless insurance was still intact. Furthermore, in marketplace, there still existed safe drivers who could be insured at rates that would provide a profit to the company. And the biggest advantage of this company is they offer premium at a very cheaper price compared to their competitors, because one, they have eliminated the middlemen, the so-called agents. So once you have eliminated agents, 10 to 20 percentage of their income is saved, so that they have passed on to their customers, and hence it makes a very excellent business proposition despite the shortcomings which we have discussed. That is the reason why uh, Buffett was very steadfast, and he understood that this company has a huge amount of competitive advantage compared to its competitors. So hence he was very steadfast, and he has picked up this particular stock. Now, whether there is any favorable long-term prospect, of course, automobile insurance is basically a commodity product, and the insurance, in fact, every customer whosoever purchases an automobile he is bound to purchase an insurance. So it is definitely a kind of a business which is sustainable in the very long run. Every year's premium have to be they have to be subscribed or renewed. If they don't, then they can't claim any further insurance for any damages to the automobile, or even when there is an accident, or even the medical claims. So this has a very good business proposition. Hence, for Warren Buffett, this business fits into his model, and also that the management in a commodity business is crucial, and he is very much satisfied with the new leadership under Bayern, and that is the reason why he has agreed to purchase this particular stock. Now let us see the candor. Candor is nothing but openness and frankness. This is one of the principle. As I explained in the past, when we were discussing about Philip Fisher. This is one of the principle he said. See, you have to be go for managers who are very open and frank, not only when the company is doing well, but also when they have committed mistakes. They have to openly admit, because after all, when we take a decision we cannot predict. In an unpredictable and uncertain world, decisions keep going awry. Sometimes the best intended decision may go bad because the circumstances have changed, and those circumstances are not in the control of the management. So hence it is a principle that any manager or the leader, whosoever admits his faults, they are the ones who can be trusted. And the vice versa, those people who are not open, who are not opaque, who keep on lying, and who always hoodwinks people, and who defrauds or frauds the people, these are the people whom we have to avoid. So what when it comes to this Geco Corporation, John Byrne, when he took over in 1976, he convinced both insurance regulators and competitors that if Geco went bankrupt, it's not only bad for the company but for bad for entire industry. Hence, they have to admit or agree, ensure that this company is rescued. So his plan for rescuing included raising of capital and also obtaining a reinsurance treaty with the other companies to ensure the portion of Geco's business and cutting the costs aggressively. The reinsurance is nothing but a business whereby the insurance company will sell that insurance premium to another company will collect or will manage the entire claims. So they will sell it for some say a premium of 100 rupees, they will sell it for some 98 rupees to the other reinsurer. 2% will be his gain. This is how the reinsurance business works. So the what he called it is, he called this operation as Operation Bootstrap, and it was aimed to increase the profitability of the company. Then in the first year, Bain has closed 100 offices. He reduced the employment from 7,000 to 4,000. He reduced the cost, especially the from the part of employees. Then he sold certain insurance companies in New York and Massachusetts, and then he decided not to renew some 2.5 lakh policies, and which would be costing the company $30 million a year. And next, he did away with the computerized systems that allowed policyholders to renew their purchase insurance without providing updated information. And then buying required the new information. He found the company was underpricing 9% of its renewable policies. So he started repricing, which is 9% above. And when the Geco repriced them, 4 lakh policyholders decided to discontinue their insurance. Altogether, Biden's action led to a reduction of policyholders from 2.7 million to 1.5, which is basically a loss to the company. And then the company fell down to the 18th largest insurer, from 18th largest to 31st in 1 year, within a span of 1 year. Despite this reduction, Geco, after losing 126 million in 1976, earned an impressive $58.6 million on 463 millions in revenues in 1977. This was the first full year of responsibility of Bayern. So clearly, Geco's dramatic recovery was basically, it was because of the able manager called as Bayern and his discipline that ensured the company earns sustainably. Okay, and what Bayern told his insurers is that company must return to its first principle of being low cost insurance provider, and his reports detailed how the company can reduce the costs.
I can erase it.
Okay. So what the company did is company continuously reduced the costs, and by 1981 it became seventh largest writer of automobile insurance. Over the Okay, now what he did is, finally by 1985 the company could underwrite all the losses, and it became, from bankrupt company to a successful corporation. So I think we will continue this further, or should we break? Yeah. Next time, next. Yeah, yeah, yeah. Break for today, right? We will continue from where we have left, right? Because this is an interesting. We need to understand these case studies. Then only you can be a better whatever investor. If you don't understand, it's a very interesting. Or should we complete it? Because only few slides are there, very less slides. Candor is almost complete. Rationality is one. Then return on equity, profit margins, determine the value, $1 premise. So should we continue for the next time, right? Yeah, yeah. I think so. So this is a nutshell. Actually, see, these are the things which how to use those 12 principles will be known. If you don't go through the case studies, otherwise it will be very dry, cut and dry. Most of the people won't understand what it is. So, any further suggestions? Suggestions for improvement? Vikas? Okay. Yeah. Uh-huh. That is very true. So, anyway, let us call it a day for today. It's, thank you very much, because bye. So, actually, today is a little concept heavy, right? But again, these, if you understand these principles, you can apply for all your future investment decisions. Because this will help you to pick the right kind of stocks. If you don't, if you make a mistake, then you are done. You can initially you can select few companies based on some some crude kind of norms, like ROC or ROE, return over equity or return over capital employed, above 15 percentage. Then you can pick up all the big companies which are market leaders in each segment. Then you can see their profitability. All these things are preliminary, but these 12 principles should be your guiding principles. Once you have identified some stocks, then out of that, what to invest, that matters a lot. And anyway, these kind of opportunities like Geco may not be available every time. Like the stock falling from $60 to $2 per share, it is very rare. And despite this company being very, very excellent, I think such kind of company, I can say one or two examples. Yes Bank is one in the recent past. Yes Bank is one such company, and I don't know. Yeah, there are any. I just need to recollect. There may be few more. Like you wait for such kind of opportunities, and then two more I can give you an example. Like one is Satyam when it crashed. The share has fell down from around 300 to 28, or sometimes it went to 11 or 12 rupees. Whosoever have purchased at that price, they are the ones who got maximum benefit. So this is these kind of opportunities keep on coming, but whenever such opportunities will come, you have definitely you should have an eye over those kind of investments and immediately invest. And recently, I invested into South Indian Bank when they issued a rights issue. The bank was trading at around 30 rupees per share, and the rights issue was 22. Though I am only eligible for 1915, despite my limitations in money, I have taken around 2000 shares. So that is also one a good decision because I'm getting 60%, 30 percentage cheaper than the market price. So what I suggest is, yes, you all have to take such advantage whenever you get these opportunities. Thank you, guys. Thank you very much. Thank you very much. Okay, bye. So this will continue even further, right? Okay, bye. Okay, now again let's restart because so Kiko's dramatic recovery was because of mine and his discipline that helped the company to regain whatever is being lost in the last 3 4 years when the company was into the difficult moments. So finally